Silicon Valley Bank (SVB) collapsed on March 10, and its customers are now waiting to hear how much of their money will be returned to them. The FDIC has said it will pay uninsured depositors an advanced dividend in the next week, but it is unknown how much this will be. Deposits are insured by the FDIC up to $250,000, so those who had balances over this amount are awaiting the outcome of the dividend decision. SVB had $151 billion of non-insured deposits as of December 31, 2022. Todd Baker, a senior fellow at the Richmond Center for Business, Law and Public Policy at Columbia University, estimates that customers will receive somewhere around a third of their uninsured balances. The process of selling assets and investments to provide money to customers could take several months or longer, resulting in hardships for customers who need to pay bills and employee salaries. All failure is failure to adapt, all success is successful adaptation. The exact reasons for the bank's collapse are unclear, but some speculate that it may have been caused by a combination of factors such as increased competition from fintech firms, changing market conditions, and high levels of debt. Additionally, increased oversight and regulation from financial authorities may have helped prevent the bank from engaging in risky practices that ultimately led to its downfall. Some critics have also argued that the high levels of debt that SVB took on to fuel its growth may have contributed to its collapse, suggesting that the bank could have benefited from more cautious financial management practices. Ultimately, it is difficult to say with certainty what could have prevented the collapse of SVB. However, many experts agree that stronger risk management practices, greater regulatory oversight, and more conservative lending practices could all help prevent similar collapses in the future. The greatest teacher is failure. Failures are part of life. If you don't fail, you don't learn. If you don't learn, you'll never change. As the bank has been shut down by regulators, there is little that can be done to reverse the situation. However, there are steps that can be taken to mitigate the damage caused by the collapse of Silicon Valley Bank (SVB). Firstly, the bank's customers and investors should be provided with clear information about the situation, including what will happen to their accounts and investments. This could involve working with other banks or financial institutions to transfer accounts and assets and providing guidance on how to manage their finances going forward. Secondly, there should be an investigation into the causes of the bank's collapse and any wrongdoing that may have occurred. This could involve regulatory bodies, legal experts, and other stakeholders working together to identify any issues and hold those responsible to account. Finally, efforts should be made to ensure that a similar situation does not occur again in the future. This could involve implementing new regulations or guidelines for banks that specialize in lending to tech companies and encouraging greater transparency and accountability in the financial sector overall. Ultimately, the collapse of SVB is a significant setback for the tech industry and the wider economy, and it will take time and effort to recover from the damage that has been caused. However, by taking prompt and decisive action to address the situation, it may be possible to limit the long-term impact and move forward towards a more stable and secure financial system.